Most Western allocators are chasing the same overcrowded deals in California and London. Meanwhile, a 2.7 trillion venture and growth market across Asia remains systematically underallocated by institutional capital. Today, we're breaking down exactly why and how sophisticated investors are actually accessing it. In this chat, we have Eric Marchand, managing partner at Collyer Capital, an asset management firm operating from Singapore, deploying into venture and growth companies across Asian markets that most Western LPs wouldn't know how to diligence, let alone structure. Welcome, Eric, to the ring.
Thanks for having me.
Let's start with question one. Eric, you are deploying into Asian venture and growth while most Western investors stay home. What's the actual arbitrage and opportunity set?
Yeah, I think it's a great question, actually. I think the arbitrage has to be split into two categories. I think the first one is you've got a category that concerns emerging markets. You need to invest your capital carefully into safe growth capital deals. And then what will that do? It will generate the same or slightly different net return than versus Western PE. But what you'll do is that you'll meaningfully decrease your return outcome dependence on any types of leverage, because the returns that you'll be delivering in the emerging markets of Asia are entirely growth driven. And then lastly, I think that arbitrage is important because if you look at your portfolio construction, you will reduce the dependence on leverage and diversify your portfolio further. So I think it's never a differentiating alpha play. It really is a play where you diversify your portfolio toward high growth economies and less leverage. When you're looking at the other part of the region, which is mostly developed markets, and I would to a certain extent now include China, deals in Japan, Korea really offer a very similar risk-adjusted return that what you would get in European or US country or US economies, and probably at a slightly more reasonable valuation. So as a conclusion to kind of my answer, it's twofold. It's quite diverse. One is more like developed markets, and the other is a truly emerging market diversifier play.
Interesting there, Eric. Let's dig in more into the allocation perspective. A lot of Western investors want to access the region, but they lack the on-site presence. What's the playbook there, and how did you jump in and not get burned across the journey?
The first golden rule, I would say, is to stop looking for that alpha in any time you're taking Asian exposure. We hear that over and over again. If I were to allocate to Asia, I want alpha to be delivered. Otherwise, it doesn't justify me allocating to this region versus my more domestic bias. I think that view has created over allocation to the VC space in this region, be it China, India, or indeed Southeast Asia. And I think that has created some trouble for a number of portfolios of endowments, family offices, asset managers in Europe or North America. And there's been a big disappointment. So the playbook is rather simple. Balance your exposures across the region. If you look at what was done over the last, 10 years from 2010 to 2020, 2021, 80 to 90% of allocations went to China. And I think a lot of people overlooked the other parts of the region. I think it's important to keep that balance because every part of the region has its own set of opportunities, and that balance will create the diversity that you want. So that's number one. Then look, you have, on the one hand, like we talked before, a whole host of countries where your risk-adjusted return is compelling and very leverage-driven to a certain extent, and very similar to what you would be used to in Western economies. And then, obviously, the emerging part of the region is clearly more of a growth-driven, a growth equity playbook. So I think what we try to do is that when we speak to family offices, asset managers alike, seeking exposure to Asia, we try to express the following view: is the more developed the economy in Asia you're going to invest in, the less diversification you need, and the more concentrated bets that you need, because the more predictable returns will be like you would find in Western economies. And then the more you go emerging, the more you need to diversify your portfolio, because even though these economies are attractive and growing and can deliver significantly superior returns, that they remain volatile. And the more diversification you get, I think the safer your bet has been.
Let's jump a little bit, Eric, more into the investment side. You run direct investments, but also provide exposure to other managers in the region. What's the most difficult part of investing in Asia?
I really can only offer a very simple answer here. You can never be local everywhere, right? So we really value as a firm the strength of partnership wherever we invest. And I think it's knowing what you don't know that makes the value of what you're doing. The challenging part of that is that because you're dependent on partnerships, you need to have the capacity of evaluating the quality of those set partnerships. And that takes a lot of time. It takes successes, it takes failures, and it takes experience. I mean, we have that in droves because, we've been doing this for over 15 years in the region. But I think it is very easy to make mistakes in who you're going to bed with. And it's very important to have the local nuances and understanding, how to diligence assess the people you're working with.
Let's jump a little bit more into the future. Give us your convictions goals. Which three APAC countries represent your highest conviction opportunity set for the next 3 years, and why?
The right parallel I'd like to give people is if you look at the Indian private equity market from 2014-15, when Modi came in and onwards, has been a real boon for India over the last 10 plus years. What I like to say to people, I think ASEAN is at that inflection point where India was in 2014, 2015. When you look at the vintages of those years in India, they were really, really, really solid. The one that might not, I think, is China. I think that would be my second bet here. I think my point here is going to be people keep up talking about China's struggles. However, China is still growing, 3 to 4-fold faster than a country like France. And I think by picking those sectors where Chinese companies are thriving, coming, global competitors, global leaders, I think you can only get it right when you invest in these companies. And then lastly, an economy that's growing 3 to 5% per annum, let's say even 3 or 4, does have a domestic consumption story. There's an aging population. There's opportunities there. There is still a story of consumption upgrade in China that is unfulfilled. And then I think my last bet would be Australia. It sounds a little bit strange, but in my view, it has always delivered consistent returns. I think if you look at the sheer economic performance of this country over the last 3 decades, it's been phenomenal. There hasn't been a crisis. They've been able to, through peak and troughs, to manage their economy. I don't see this responsible stewardship of the economy in any shape or government even change. It's always been very, very steady Eddie. And the fundamentals of this country are very, very strong. And so I would bet my money on Australia being a very interesting investment opportunity.
Super interesting, Eric. India, China, and Australia, guys. Take a look at those countries.
ASEAN.
Yeah. And thanks a lot, Eric, for your time, for being here, sharing your wisdom. The ASEAN market is not very well known for Western investors, and having a loop over there, thinking about a global diversification is one of the keys to building a resilient portfolio over time. Thanks a lot.
Thanks for having me.